Brad Williams, Frugal Finance, the different types of mutual funds, fund objectives. Well, there are thousands of individual mutual funds. There are only a handful of major fund categories. Stock funds, which invest in stocks. Bond funds, which invest in bonds. Balanced funds, which invest in a combination of stocks and bonds, and money market funds, which invest in very short-term investments and are sometimes described as cash equivalents. Within the major categories of mutual funds, there are individual funds with a variety of investment objectives or goals the fund wants to meet on behalf of its shareholders. Here's just a sampling of the many you might find. Stock funds. Growth funds invest in stocks that the fund's portfolio manager believes have potential for significant price appreciation. Value funds invest in stocks that the fund's manager believes are undervalued in the secondary market. Equity income funds invest in stocks that regularly pay dividends. Stock index funds are passively managed funds that attempt to replicate the performance of a specific stock market index by investing in the stocks held by that index. Small, mid, or large cap stock funds stick to companies within a certain size range. Economic cycles tend to favor different size companies at different times. So, for example, a small cap fund may be doing very well at a time when large cap funds are stagnant and vice versa. Socially responsible funds invest according to political, social, religious, or ethical guidelines, which you'll find described in the fund's prospectus. Many socially responsible funds also take an activist role in the companies where they invest by representing their shareholders' ethical concerns at meetings with company management. Sector funds specialize in stocks or particular segments of the economy. For example, you might find funds that specialize solely in technology stocks, in healthcare stocks, and so on. Sector funds tend to be less diversified than funds that invest across sectors, but they do provide a way to trade in a potentially profitable segment of the economy without having to identify specific companies. International, global, regional, country-specific, or emerging market funds extend their reach beyond the U.S. International funds invest exclusively in non-U.S. companies. Global funds may invest in stocks of companies all over the world, including U.S. companies with global businesses. Regional funds focus on stocks of companies in a particular region, such as Europe, Asia, or Latin America, while country-specific funds narrow their range to stocks from a single country. Funds that invest in emerging markets look for stocks in developing countries. Bond funds, there's an important distinction between owning an individual bond and owning a fund that owns the bond. When you buy a bond, you're promised a specific rate of return in return of your principal. That's not the case with a bond fund, which owns a number of bonds with different rates and maturities. Equity ownership of a bond fund provides the right to a share of what fund collects in interest, realizes in capital gains, and receives it back if it holds a bond to maturity. Corporate, agency, or mutual bond funds focus on bonds from a single type of issuer across a range of different maturities. Short or intermediate term bonds focus on short or intermediate term bonds from a wide variety of issuers. Treasury bond funds invest in treasury issues. High-yield bond funds invest in lower-rated bonds with higher coupon rates. Other funds, balanced funds, invest in a mixture of stocks and bonds to build a portfolio diversified across both asset classes. The target percentages of each type of investment are stated in the prospectus. Because stocks and bonds tend to do well during different phases of an economic cycle, balanced funds may be less volatile than pure stock or bond funds. Funds of funds are mutual funds that invest in other mutual funds. While these funds can achieve much greater diversification than any single fund, the returns are affected by the fees of both the fund itself and the underlying funds. Also, redundancy might cut down on diversification, such as if several of the underlying funds hold the same investment. Target-dated funds, sometimes called lifecycle funds, are funds that change their investments over time to meet goals you plan to reach at a specific time, such as retirement. Typically, target-dated funds are sold by date, such as 2035 fund. Farther away the date is, the greater the risk the fund usually takes. As the target date approaches, the fund changes its balance of investments to emphasize conserving the value it has built up and to shift towards income-producing investments. Money market funds invest in short-term debt, such as treasury bills, and very short-term corporate debt known as commercial paper. These investments are considered cash equivalents. Money market funds invest with the goal of maintaining a share price of $1. They're sometimes considered an alternative to a bank savings account, although they aren't insured by the FDIC. Some funds have private insurance. SEC rules require a mutual fund to invest at least 80% of its assets in the type of investment suggested by its name, but funds can still invest up to 1/5 of their holdings in other types of securities, including securities that you might consider too risky or perhaps not aggressive enough. Investors should check the latest quarterly report showing the fund's major investment holdings to see how closely the fund manager is sticking to the strategy described in the prospectus and whether you might be exposed to any risk you aren't prepared to take on. Active versus passive? When a fund is actively managed, it employs a professional portfolio manager or team of managers to decide which underlying investment to choose for its portfolio. In fact, one reason you might choose a specific fund is to benefit from the expertise of our professional managers. A successful fund manager has the experience, knowledge, and time to seek and track investment, key attributes that many investors may lack. The goal of an active fund manager is to beat the market, to get better returns by choosing investments that they believe to be top performing selections. While there's a range of ways to measure market performance, each fund is measured against an appropriate market index or benchmark based on its stated investment strategy and the types of investments it makes. For instance, many large cap funds typically use the S&P 500 index as the benchmark for their performance. A fund that invests in stocks across market capitalizations might use the Dow Jones Wilshire 5000 Total Stock Market Index, which measures more than 5,000 small, mid, and large company stocks. Other indexes that track only stocks issued by companies of a certain size or that follow stocks in a particular industry are the benchmarks for mutual fund investing in those segments of the market. Similarly, bond funds measure their performance against a standard such as the yield from the 10-year Treasury bond or against the broad bond index that tracks the yields of many bonds. One of the challenges portfolio managers face in providing stronger than benchmark returns is that their fund's performance needs to compensate for their operating costs. Returns of actively managed funds are reduced first by the cost of hiring a professional fund manager and second by the cost of buying and selling investments in the fund. Suppose, for example, that the management and administrative fees of an actively managed fund are 1.5% of the fund's total assets, and the fund's benchmarks provides a 9% return. To beat that benchmark, portfolio manager would need to assemble a fund portfolio that returns better than 10.5% to account for those fees. Anything less, and the fund's returns would lag its benchmark. In any given year, most actively managed funds don't beat the market. Fact, studies show that the very few actively managed funds provide stronger than benchmark returns over long periods of time, including those with impressive short-term performance records. That's why many individuals invest in funds that don't try to beat the market at all. They are passively managed funds, otherwise known as index funds. Passive funds tend to replicate the performance of their benchmarks instead of outperforming them. For instance, the manager of an index fund that tracks the performance of the S&P 500 typically buys a portfolio that includes all the stocks in that index in the same proportion as they are represented in the index. If the S&P 500 were to drop a company from the list, the fund would sell its shares in the company, and if the S&P 500 were to add a company, the fund would buy that company's stock. Because index funds don't need to retain active professional managers, and because their holdings aren't as frequently traded, they normally have lower operating costs than actively managed funds. However, fees vary from index fund to index fund, which means the funds on those funds varies as well. Some index funds, which go by names such as enhanced index funds, are hybrids. Their managers pick and choose among the investment tracked by the benchmark index in order to provide a superior return. In bad years, the hybrid approach might still be able to produce positive returns or returns that are slightly better than the overall index. Of course, it's always possible that this type of hybrid fund won't do as well as the overall index. In addition, the fees for these enhanced funds might be higher than the average for index funds. Comment if you have any questions as it relates to the types of mutual funds. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.